A 53-year-old millionaire, married with three beautiful daughters, was living comfortably in his own house in a nice area. He had invested his money in the stock market and built a solid portfolio of stocks. Unfortunately, the market suddenly collapsed and the value of all his stocks plummeted. Not only did he lose all his money, but he also became heavily in debt and was on the brink of bankruptcy. Overnight, he went from being a millionaire to being in debt and facing the possibility of losing everything. How did he become indebted? He was using borrowed money to trade on the stock market, around $10 million, half of which was his, and the other half was borrowed from the brokerage firm he was trading with. This type of transaction is called buying on margin in the market. The brokerage firm lends you money to invest alongside your own, essentially doubling your investment potential. However, when the stock prices fell drastically, the brokerage firm contacted him, informing him that he had lost nearly all his money, approximately $5 million, and that he now owed them $130,000. The man, who had been friendly with the employees at the brokerage firm, left to get the $130,000 and returned to the office later that same day, carrying a bag that was supposed to contain the money. But instead of money, the bag contained a .357 Magnum. He had bought the gun, returned to the office, and shot 4 bullets. The first two killed the office manager and the vice president of the brokerage firm instantly. The third bullet hit a broker, paralyzing him, and the fourth bullet he aimed at himself, committing suicide. This tragic event happened in October 1987, coinciding with the sudden collapse of global stock markets, particularly the U.S. stock market on October 19, 1987, a day Americans refer to as Black Monday. This day marked the beginning of the first modern global financial crisis. The entire world was suddenly reminded of this on Monday, August 5, 2024, when stock markets around the world plummeted violently, with the biggest shock occurring in the Japanese market. The Nikkei index recorded its worst daily loss since Black Monday in 1987. The same scenario keeps repeating itself, driven by greed and the underestimation of the dangers of easy borrowing and speculating with money that one does not own. What makes the recent crisis particularly alarming is that it has occurred at the worst possible time and could spiral out of control at any moment. So, what exactly is happening in global financial markets? Who is behind it? And how did we lose more than $6 trillion in a matter of days? Why have so many investors suddenly withdrawn their money from developing countries, putting pressure on their currencies? These are some of the topics we will discuss in today's episode. I'm Ashraf Ibrahim, the Economic Informant. On March 6, 2013, the University of Chicago hosted a lecture on the future of Japan's economy. The keynote speaker was the American investor Kyle Bass, one of the world's most famous hedge fund managers. About 36 minutes into the lecture, a cheeky student from the audience asked Kyle a very striking question. What would be the first thing you do if you found yourself tomorrow as Japan's Minister of Finance? Without hesitation, Kyle replied, "The first thing I'd do is resign." He explained that Japan had changed 10 finance ministers in 5 years, with one committing suicide and another being hospitalized due to stress while trying to balance the 2011 budget. So, why would he want to go there? This strange response reflects the unique nature of Japan's economy, an economy unlike any other in the world. People who deal with it acknowledge that sometimes the Japanese economy does not conform to the economic principles found in textbooks, leaving them puzzled and helpless. The famous economist Simon Kuznets, a Russian-American who won the Nobel Prize in economics, had a humorous comment in this context. Kuznets said that the world's economies could be divided into four categories: developed countries, developing countries, Argentina, and Japan. The Japanese economy is in a class of its own. One of the most notable features of Japan's economy, particularly in the last quarter century, has been the extremely low interest rates, sometimes even negative, regardless of global economic conditions. While central banks around the world, led by the US Federal Reserve, have been raising interest rates to record levels following the Russian-Ukrainian war, the Bank of Japan has remained firm, keeping its interest rates between zero and slightly negative. The reason for this is that Japan has been grappling with a chronic problem: low inflation, with prices sometimes even declining, which is a disaster for an economy because healthy economic growth requires a reasonable rate of inflation. Japan's prices haven't been rising because the Japanese people suffer from a trauma due to the severe financial crisis they experienced in the early 1990s when the real estate and financial asset bubbles burst. They suffered the consequences of this for a decade, a period known in economic history as Japan's lost decade. During this crisis, property values in Japan fell by 87% compared to their peak before the bubble burst. The massive drop in stock and property prices caused Japan to lose wealth equivalent to 3 years of its GDP, according to Richard Koo, chief economist at the Nomura Research Institute in Japan, who described it as the largest loss of wealth by any country in peacetime. After this crisis, a different version of the Japanese citizen emerged. The Japanese, known in the 1980s as some of the world's most extravagant spenders, suddenly became more inclined to save rather than spend. In response, the Bank of Japan, to encourage spending or investment and prevent money from sitting idle in banks, reduced its short-term loan interest rate to 0% in the first quarter of 1999. From the late 1990s to the present day, the Bank of Japan has remained in a unique position, maintaining its key interest rate close to zero, sometimes slightly above, sometimes slightly below, even as the global economy fluctuated wildly. The US Federal Reserve, which has been aggressively raising interest rates for over 2 years now, raising them 11 times and consequently pushing up interest rates worldwide, is a major factor behind the recent crisis. The financial markets, expecting this to continue, decided to increase borrowing, which the Fed has been making since January 2017. This have then Oil of East Middle, a located company drilling nonprofit is Corporation Company Oil National. The Resources Oil Global for competition intense in plays Qatar of State Arab the of division economic the into follow should you.